We are very lucky indeed to have someone I met last year in a beautiful surroundings at a conference in Spain, Dr. Clément Fontan, who is a graduate of the University of Grenoble, but more importantly for us is currently a postdoctoral fellow at the Institute of, help me out here, Clément, it's
Center of Research.
Research Ethics at the University of Grenoble, where he's going to be there for about 2 years. And one of the interesting, his work is on the ECB and the politics of ECB and the connections of this central bank with the financial markets. But he also has a wonderful interest in philosophical and moral issues as well. And we're going to get a little bit more of that today, as he's going to talk about central banking and inequality, taking off the blinders. Mr. Fontan, take it away.
Yeah, thank you very much. Thank you very much all for being here. First, I apologize for my poor English. I got a terrible French accent, and sometimes you might not follow me perfectly, so just stop me and I will try to do my best. Or if it's too technical central banking stuff, again, stop me and I will try to explain as best as I can. So what I'm trying to do today with you is that I try to gather a bit all my research interest on central banking to present a proposition of analytical framework of how can we analyze central banks from a political point of view. And I will try as well to make the case that the analysis of central banks should indeed be at the center of any IPE research agenda because of their pivotal role between states and markets. And we will go more in detail into that. So as a starter, I want to point out that many research projects are included in this presentation, but I make the choice not to go into the details of every research project so you can have a global overview of my work on central banking. So if you want any indication, more precisions and so on, please, I think we have a question time after that, so I wanted to present it this way. So what I'm going to do today, what is the context of the talk first, is that we know all that central bankers are on the forefront of the political authorities' answer to the crisis. They were one of these major institutions that took a big part in the policy answers. And what I want to do is to focus on the unintended consequences of their monetary policy shift. In other words, how did the paradigm change in monetary policy impact political system and society today? What are the distributive consequences, if there are any, and how can we avoid them or make them better? So my goal is to conceptualize central bank politics, but I already told you about that, and as well engage a dialogue about policy alternatives. So this is very new for me because as a good French person, I'm very cynical, and as a good researcher, I do not like to propose policy solutions. But after teaching for so many years, my students were a bit bored about that trait of character of me. So with my research team, we are trying actually to talk to central bankers and try to provide alternatives to them. So my thesis is in 2 points. That first, the central bank's relationship with financial market is biased. It was before the crisis. It is even more now. And I will show how this bias is a democratic problem. And second, I think that that central bankers should rethink their monetary tools outside of the regular monetary channels. And this is a stronger claim of the paper. Maybe I will convince you, maybe not. But we will see how we will go into that. So my presentation will be in three parts. The first will a bit conceptualize what a central bank is and how can we analyze a central bank from a political sciences point of view. The second will be a description and an analysis of the central bank policies after the Lehman Brothers crash, and then we will go on trying to show if the other alternative that could have been to these policies. So first, What is a central bank? As I told you, it's a kind of recent institution. It appeared in their modern form in the end of the 19th century, and it's basically an interface between financial markets and states. We can conceptualize central banks as part of the state activities to try to capture and regulate finance and money activities onto their territories. So how do they do that? Basically, the mission of central banks around the world have always evolved in function of their autonomy towards both financial markets and state. It changed in periods of history according to economic paradigms and so on. But what they did always do was that they were always focusing on price and financial stability. So that was a constant in central bank history. And how do they focus on price and financial stability? Okay, so this is a little typo mistake because both of these two lines should be the same size. There is no hierarchy here. It's first and foremost a liquidity provider. So it has the monopoly on the legal tender. It's the ultimate authority, it's the lender of last resort, which means that when no other financial institution can provide liquidity to a financial system, the central bank does. Okay? So according to the word of a famous bankers, a central bank is first and foremost a bank. All right? But it's not just a bank, because since the 50s, central bank became as well public administration. And since the 80s, public administration shifted into research centers. Today, the bulk of the research into monetary policy and financial issues is done by central banks. So there are two things. There are a bank and there are expert institution as well. And these two things represent their two channels of influence, meaning that through their monopoly on liquidity, they can influence politics, and through their expert influence, they can, they have something to say as well on other fields than monetary policy. All right? So now, in which paradigm are we living in? We are living in the central bank independent paradigm. So actually CBI, no, it's independent central bank paradigm anyway. So the context is that in the 80s, we all know that the main policy problem was the high inflation. We have a spread of neoclassical ID. So basically, the theoretical foundation of independent central bank is the time inconsistency problem, which means that if monetary policy is not protected from elected official influence, these elected officials will have incentives to impact on monetary policy basically for partisan reasons. So before any election, they will try to open the flood of money, and it will spur higher inflation because they will try to give gifts to the electorate. It's very roughly the theoretical foundation of the central bank independence. So how can we dodge this problem? Is that by isolating monetary policy from electoral pressures, we gain the trust and confidence of financial market. And thanks to this trust and confidence, financial market participants do not factor in inflation expectation, because they do believe that it will not move, and they can trust price stability on the middle and long term. So this is the theoretical foundation. So the beliefs in this theory, plus the coercive pressure on international institutions such as IMF or European Union, it led to a spread of this paradigm at the end of 80s and beginning of 90s, and nowadays almost every central bank is independent from political authorities. Another outcome of this paradigm shift is that there was a scientificization of monetary matters. It means that central banks, as I told you just before, have more and more control over the monetary matters, They are the legitimate voice, they are the legitimate expert voice to speak about monetary matters. So that helps them to isolate themselves from criticism, because they can say, well, basically, you know, it's a central banker stuff. We know what we do, you don't really know. So we have the legitimacy to talk. But it brings them as well legitimacy to speak on other macroeconomic issues, like financial regulation, for example, financial supervision, macroeconomic policy, structural reforms, and so on and so on. All right? So this is the world we are living in, and which was dominant just before 2008. Now, we have completely forgotten about one thing, like central bank independence, it's like a coin. It has two faces. The first is independent from political authority, but let's not remember the other side, which is it should be independent as well from financial markets. And this was forgotten a lot in the central bank literature from the beginning of the 90s to approximately today, where it's coming back a bit. So what do we know about that? We know that central bankers believe in stable, or believed at least, in stable and efficient market. Why? Because it's part as well of the theoretical foundation of their independence. If there was not about financial market expectation about the outcomes of their independency, they would not have theoretical foundation for their independence. So they have vested interest into the spread of this stable and efficient market hypothesis. All right? So this belief and this willingness to foster financial market developments led to two phenomena. So we have the US, very famous now, Greenspan beginning neglect policy. So we all know that it is low interest rate. We do not care about housing bubbles, because bubbles do not exist, because markets are stable and efficient and so on. We all know that story. It has been documented, so let's move on. What is more interesting is that we don't know the European side of this history, because the European Central Bank is had the reputation of being a more conservative bank, less close to the financial markets and to the banks and so on, more interested into price stability, being German and all the story around. But what we do know, in fact, is that the ECB was one of the responsible of the Eurozone imbalances. And I will try to explain why in 2 minutes, max, which is not an easy task. So basically, we all know how the subprimes worked. The subprimes worked as a collateral in the repo market for financial institutions to trade other financial products, like, for example, derivatives. All right? So the repo market is a bilateral market where you can loan between two partners, and the supervisor will have no oversight over it. All right? But so to trust your counterpart, you need a collateral in the loan, and there were some financial assets that were reputed as more secured and which were accepted in this collateral in the repo market operation. That's why everybody wanted subprimes. Okay, it generated high yields, but it helped as well to maximize your operation on the repo market. And basically, you take the subprimes off and you bring the sovereign bonds in, and that's the European story. Why? Because we have this Liikanen report in the beginning of the year 2000, which stated that Greek, Italian, Spanish sovereign bonds were the same worth than a German, Finnish, French, or Netherlands bonds. So basically, on the repo market, whatever the sovereign bond of the Eurozone country you have, you could do the same operation. Okay? And of course, the Greek bonds were much less expensive than the German ones. So it was very profitable for financial players to invest into the sovereign debt of Eurozone peripheral countries. All right? And the ECB was one of the institutions that fostered that development in the name of financial integration, and financial integration was fostered in the name of European integration. So that was Oscar Wilde who said that the path to heaven is paved with bad ideas, something like that.
Path to hell is paved with good intentions.
Yeah, thank you. So basically, the problematic belief of European central bankers and American central bankers into stable and efficient market was one of the cause of the apparition of the Toobigtofail phenomena. Because what I forgot to say is that the European banks which were trading the sovereign bonds on the repo market, they doubled the size of their balance sheets in less than 10 years. Okay, so the major financial players in Europe became twice their size in 10 years, thanks to this operation. So this is kind of a big deal. All right, so now we're here. We see that central banks were part of the problems indeed, because they helped to create speculative bubbles. And as every speculative bubble, one day it explodes, and here we have the great bailout. So I will try to explain in a few words the monetary policy shift that was implemented by central bank to save the financial system, and then I will try to explain what was the conditionality of this help, and I will finish this part of the presentation by explaining the policy outcomes of this monetary policy shift. All right. So first, these are the three major central bank balance sheet as percentage of the GDP. All right. So we see that in 2008 we are entering into a new world. What is a balance sheet of a central bank? It's like of every household is all what you held and all what you own. And the bigger is your balance sheet, it means that the bigger role you play in the economy. It's called the intermediation role. The more your balance sheets take percentage of the GDP, the more you substitute the banking system. All right? So the size of the balance sheet is an indicator for the intermediation role of central bank in the economy. So before we have to imagine technocrats who were playing with levers and trying to give subtle indication to financial market about interest rate policy. Now we have to imagine central bankers as mechanics trying to fix the engine of the plane while it's still flying. All right? So that's one of the indicators for that. So this is the total asset with base 100 in the year 2003. So again, we can see that it dramatically expanded since 2008. And actually, we have two phases. The first one is 2008, 2011. And 2011, the crisis worsened in Europe, and we have a reaction of the three major central banks as a consequence. So what does it mean, basically? How does it work? So a central bank, their job is to do basically open market operation. What is an open market operation? It's an auction in which the central bank provides liquidity to financial market participants, and in exchange, financial market participants have to give you a collateral. So it's a financial asset that they give you and that you hold the time they reimburse you liquidity. All right, that's how central banks are providing liquidity to the banking sectors. So basically, they kept the same tools during the crisis, but they extended it, and they extended it dramatically in two ways. The first is that they were providing liquidity at very much relaxed condition in comparison with before. Before, we have to imagine that there was a certain amount of liquidity that was given to banks every month or every 2 weeks, and it was at a fixed rate, which was kind of high, and with collateral of high quality. Now we're giving liquidity for 3 years at a 1% rate with much less quality asked in the collaterals. So basically, we're giving more money for less guarantees. So that's the first kind of instrument. Second kind of instrument is that you are doing it the other way around. That is the central bank which goes on the market, which buy government bonds, and in exchange they give liquidity. So in the one case, the central bank is sort of the seller, and the other case, the central bank is the buyer on the financial market. But these two tools are open market operation. You deal with financial market operators, and you trade liquidity against collateral. Okay. On this side, the central bank, the private bank which are asking for liquidity, and on this is the central bank which is asking for government bonds, but it's basically the same mechanism. So now, which conditionality for this help? As I was saying, like in the case of the banks, we give more for less. So very few conditionality. Basically, when central bankers are providing liquidity to the banking sector, they are not controlling how the banks are going to use this liquidity. All right? So this is a bit problematic. And it's the same with the purchase of government bonds, because the aim of the purchase of the government bonds is to revive growth. All right? Problem is that it's supposed to work through three channels. The first one is the wealth channel. So basically, when you're buying assets, the prices of assets rise, and when the price of asset rises with a kind of trickle-down effect, it's supposed to help everybody. The second is the portfolio effect, meaning that when the central bank is buying sovereign bonds, which is supposed to be one of the safest assets, you will turn your investment into riskier assets, and so you will lend more to small companies, for example. And the third channel is the trade that is supposed to boost your trade because your exportation will rise because your currency will go down, basically. Well, what we do know is that, again, financial players are benefiting from this purchase of government bonds. And again, we did not ask that much from them. On the opposite, in Europe, there was a huge discrepancy of conditionality when the ECB was intervening to support failed states in comparison with failed banks. So failed banks, it's what I just explained you. Failed states, the European Central Bank was purchasing government bonds only if the governments was implementing structural reform, budget cuts, austerity policy in the world. So this is my PhD, so I will not do it again from A to Z, but I will just drop three examples. For example, the ECB was the only player in Europe able to impose the fact that the Greek bonds were, at the end of the day, Greek bonds had a haircut, but it was delayed for years because of the ECB, because it threatened the bankrupt of all the Eurozone financial system in the world. When the ECB was fed up with Silvio Berlusconi, I can understand why, but still it's not okay from a democratic perspective. They stopped to purchase government bonds, and Silvio Berlusconi had to resign. So independent central bankers basically decide which governments European citizens are going to have, and so on and so on. And cherry on top of the cake, the ECB agents are part of the Troika groups, which control the conditionality of the implementation of austerity plans. So basically, the ECB is the only one to decide that you are doing austerity, otherwise we are not going to help you. And besides, we are going to define what the austerity is, and we are going to check that it's well implemented, otherwise we are stopping to purchase your bonds. So we can see that it's a huge increase of influence, and a really tight conditionality in the case of states, and a really weak conditionality in the case of banks. So, what are the policy outcomes of all of this? can we say mission accomplished in an aircraft carrier and next to the Iraqi coast and say that everything is good? Well, it's true that we had no major financial crash since Lehman Brothers. It's true that we have a buoyant stock market, yet we see no proper economic recovery, especially in Europe, and we see a rise in inequalities, and that might be the most problematic of all. And I'm going to scrutinize this a bit more in the 5 minutes left I have to talk. But just before doing that, some graph. So the purple line is the US investment, all right, and the green and blue line are the SP50 and FTSE 100, so composite index for stock market evolution. So we can see that when the Fed announces that it will purchase government bonds, the markets are going crazy, okay, again and again, but investment is not moving. So we can see that QE has an effect through the wealth effect on stock market evolution, but it does not stimulate growth. All right? But what does it do? It helps inequalities to rise. And why is it implying a rise of inequality? It's because the wealth effect, the fact that the central bank is purchasing government bonds, it benefits first and foremost to the financial market participants and to the one who already own financial assets. Okay, if the price of your financial assets rise by 200%, you are going to benefit from it. And who is already owning the financial asset is the most well-off. All right? And so what does the company do with the fact that the stock market is buoyant and so on? Do they use this opportunity to invest? No, they use this opportunity to either buy back their share or to do a net bond insurance, and these are financial techniques to give money to your staff. Because now we have more and more regulation on wages, but if I showed you wages on the financial sector, evolution of wages in the financial sector, it will show the same tendency. It had a brutal drop in 2008, 2009, and since then it's rising again. So basically we have more liquidity on the financial markets thanks to the central banks, but this liquidity stays stuck. The wealth generated by this liquidity stays stuck in the financial market, and it's translated only by an increase in wages of the people who work there and by an increase in the share buybacks. So it's a technique equivalent to give money. So how do central bankers justify themselves? There are justification in 4 points. First and foremost, they say that it's the governmental responsibilities to deal with the inequalities that are created because it's not their job. All right. Second, and this is the principle of the double effect, Thomas d'Aquin and so on. Second, they say that it's unintentional. It was not their aim to generate inequalities. They say that there is as well a proportionality. If they would not have acted, inequalities would have been worse because financial crashes impact the less well-off. And then, anyway, we had no alternative. We had to do that. And I forgot one point, but in the temporal issue, they say as well that it's only temporary, that it will not last, and that they will exit this as soon as they can. Okay? Now, with my research team, we wrote a whole 45 pages paper on that, so we have to reduce it to publish it, and it's a big problem, but we were trying to show the blinders of this policy justification, and we found 2 sets of blinders. First, about the temporality, we disagree with that. because we checked into the records, the minutes, the speeches of the central banker of the three major central banks since 2008, and we see no concerns at all about distributive issues until 2013, 2014, when inequalities became again kind of sexy. So that is a problem. Like, you cannot say that there was no alternative when you were not looking for any alternative, at least since between 2008 and 2013. Second, you say that it's only temporary. Well, beside the fact that it's supposed to be only temporary since 2009, 2009 was already 6 years ago, which is quite a while in our modern time. We can say as well that this exceptional monetary policy might be there to last, because kind of very left-leaning Marxist sources such as the IMF, OECD, and Bank of International Settlements, they all say that we are facing a no-growth or almost no-growth future. So if we are in a no-growth future, how can you exit from this exceptional monetary policy that are not supposed to last? This is a bit problematic to us. And second, and maybe most importantly, we disagree with the fact that there was no alternative. Actually, we see one alternative, which is called the helicopter drop option, again proposed by a very dangerous Marxist called Milton Friedman. So what did Milton Friedman propose? He said basically that let's imagine an helicopter flying on the top of a community and dropping $1,000 bills to everybody. So basically, it's what we do with the purchase of government bonds. All right, when central banks expand their balance sheets, they are creating money. But the created money, it goes straight and it benefits first to the people who are the closest to the liquidity creation, so the financial market participants. But let's imagine that we can bypass the financial sector, and instead of purchasing government bonds, we give every citizen a check of $1,000. The liquidity generated will be the same, but it will provide it directly to citizens and households. Okay? Of course, central bankers will not write down a check, but we can imagine a situation where central bank, for example, finance a public institution which is aiming at reducing inequalities, like let's say, for example, with a program of building houses for low-income households and so on and so on. So it would have the same effect, stimulate economic recovery, but it would have less undesirable effect, like increasing inequalities. So the question we would like to ask to central bankers is, why didn't you seriously take this into consideration? Again, it was Milton Friedman, but Mark Blythe proposed this as well. Former Bank of England central bankers are talking about it as well. So it's a known subject in the community, but they are still not considering it seriously. And last, when they say that it's not their job to tackle inequalities, maybe, but they render the job of fiscal authorities very problematic. Why? Because the rise of asset price, so it's the main effect generating inequality. We all know that fiscal authorities have very lot of troubles to control financial assets wealth. All right, this is the hardest class of wealth to control because it's mobile and it can go very easily to tax haven, it can be dissimulated very easily, and so on and so on. So the kind of inequalities that central banks are generating are very hard to correct afterwards. All right? So this is the second set of blinder according to us. So as a conclusion, we invite central bankers to think outside the box of financial markets and consider seriously policy alternatives such as the helicopter drop. And between researchers, I would like to indicate two future research venues in this program of political analysis of central bank. The first would be to investigate a bit more this link between central bank and commercial banks, understand why there was a very weak conditionality in their financial rescue, for example, which role central banks are playing in the regulatory field, what kind of advice they are generating on the financial supervision we should have, and so on and so on. And the other research venue would be to compare central bank with other regulatory agencies, such as the FDA, for example, to understand how they are managing to build their expert reputation and isolate themselves from outside criticism. So that was it. Thank you very much for your attention. Thank you very much.